red, red, red September. Markets are down. My portfolio's been down in September. So here is my full transparent update, a regular update to keep you guys informed as to what's going on. So in August, just as a refresher, I was at 41,344. That is now 38,844, which is a very large decline. So the 38,844, let's first of all look at the top right of the screen where you've got the targets to the year end. So by the end of this calendar year, to hit my £1 million long-term challenge, which is my goal, which is what I'm following on this channel. If I want to hit that million by 2060, I need to be at 35,803 by the end of the year. So I'm cool for that at the moment. If we go down to the stretch target, which is by 2050, bringing it forward 10 years, still just putting in that minimum £300 a month. I need to be at 38,536 by the end of the year. So I'm what, £300 above that. And because I'm putting 300 a month in, there's another 900 to go in by the end of this calendar year, October, November, December. So I'm still kind of on track to hit that number. So that's really great. But since last month, let's not gloss over it. It's there, nice and clear. I'm down £2,800 in terms of performance. But I have added a £300 deposit, so effectively £2,500 down in a month. Now, October's been a good start. First couple of days of October, already about £1,000 up. So things are moving really quick in this volatile market. I'm not too worried about it. There are a couple of companies that we'll see that I'm not happy with in the portfolio that I want to get rid of. But most of the holdings I am at least content, if not very happy with. So this is something that's really important to me, this required rate of return. I don't see anyone else talking about it. And for me, it's absolutely key because I need to know what rate of return I need when I'm buying a position or keeping a position or selling a position, what rate of return I need to hit the £1 million by 2060 or 2050. So I need that 6.5% a year to hit it by 2060, or for 2050, 9.61% a year. And those rates have moved up slightly, as you can see on screen there in brackets, compared to last month. I know if I hit £300 a month, then I get 9.61% a year compound annual growth rate. That should get me to that £1 million mark by 2050, which is my long-term goal. So if you're interested in that, please do follow me on these monthly portfolio updates. It's really key for me to know this run rate. So if I'm buying a dividend stock, if I'm buying a quality company, I know that rate that I need to hit. So when I'm doing my cash flow calculations, the dividend calculations, I know the discount rates, or at least that I need to get to. I know what I need. Really important for me to consider that in any purchase that I make. I'll do a quick comparison versus the FTSE 100 each month. Last month it was above, this month it's a little bit below. Now, dividends into the portfolio, almost £100 in September, and around about a quarter of that was through Aviva at £25.44. Other notable names, Legal & General, 1088. Love that company's dividend stock, also really good. Unilever's been ticking away nice dividends for me over many years, £6.90 there. And even the coal miners now giving me dividends there. Ramaco Resources at £3.60. So those were dividends in this month. Do drop me a comment below if that kind of overlaps with your portfolio. If you've got any of those holdings, we'd really love to hear what dividend stocks you've got and what's bringing you some extra cash into your portfolio. I have sold one fund, Marlborough UK Microcap, in September. It's a really small holding. It was £100 or so, almost pointless at that level. So I've simplified the portfolio, rationalised it, and got rid of that one. 3 buys, Fundsmith Equity Fund. I'm adding that every month. I'm adding £100 a month of it. So that is my regular purchase. I want to build up a really nice position in that fund. I added a touch of Legal & General towards the end of September as it dropped off in the market pricing. The market pricing pretty much got to where it was when I bought my original tranche, so I added a little bit. And if it drops off more, I will add some more to that position. I'm very happy. It was 1% of my portfolio. I'm very happy for that to get to 3% of my portfolio. I also added some Adobe. That was before the results, so they cratered, if you want to use a technical phrase, after the results. Absolutely destroyed because of the market view of the acquisition that they made, that they overpaid for it. I think that was one of the main things. I still haven't quite worked out whether I'm happy with the price and how they've done that deal. So I haven't sort of averaged or bought a higher position. So I'm still trying to work that out. So my portfolio is split into cyclicals, dividend stocks, managed funds, and quality companies. Start with the cyclicals. I don't have a target for cyclicals, but I don't want it to be more than 10% of my portfolio because it's more intensive in terms of trying to find the ones to buy and also timing the sell, which you have to do on cyclicals. So it's more intensive, it's actually harder. So therefore, but the opportunity to make very large returns is there, as you can see from the top 2 on that list, both coal miners Electrical Resources, £2,700, my biggest position. Great, absolutely fantastic. And there's a dividend coming soon as well, another dividend. Ramaco Resources also come on. I halved that position in that one a couple of months ago. Bad month in terms of the market. Only other one to flag there is Altasource, which is up in a month. That is related to the US housing market. There's lots of foreclosures, which with the interest rates going up and the economic situation in the world, particularly in the West at the moment, they could be about to do very, very well. Dividend stocks, which I'd like to be around about a quarter of my portfolio. And the largest by far is Unum Group, and that's the largest because I had the most conviction that it was undervalued and could keep paying a good, increasing dividend over time, which is amazing. Love that company. Aviva is probably my next favourite on that list, and it is indeed the second biggest, which is great. It was over a 50% return in a couple of years there. It's dropped to 44%, but very happy just to hold that one. I'd flag out Walgreens, which is just edging down and down and down in price, getting towards $30. And I think if it goes below 30, it starts looking quite interesting to add to the position as a dividend stock. So I just need to make sure I can hit that potential rate of return that I mentioned in a prior slide in order to add to that position. And you can see there, Legal & General that I mentioned earlier at £541. That's dropped a lot in this month, hence the small addition. Drops more, I will definitely add more to that. So it's just over 1% of the portfolio. I'm happy for that to be a lot more. My quality stocks, I do not have enough money in this pot. The Terry Smith quality stocks. I'm not saying they're exactly the same as ones he would buy, but in terms of at least the metrics, we're talking like return on capital rates, margins, cash conversion, that sort of thing. These companies are fitting the bill. Maybe they're slightly different industry, someone's what he would buy, but if I just want to copy him, I might as well buy his fund, right? So this is my idea of what I want as quality stocks in my portfolio. Bankno's okay, is my favourite on that list, so I'm happy that it's by far and away the biggest, and I've done really well on that one. I'd love to add more Broker Express. You see that it's down in month. That keeps dropping. I will want to add more. It's an amazing company. Same with Berkshire Hathaway, although I realised with buying Berkshire, I double up on American Express because they own part of American Express. Controversial question mark though on Intel. I'm still 50-50 on whether this is a quality or dividend stock. What's your view? I'd love to hear that below, please. Is Intel worthy of inclusion on this list? Certainly it generates a lot of cash, but, well, big margins historically, but is it actually a quality company based on all the metrics? So the managed funds, this is my protection against my own failure. I want this to be around about 20 to 25% of the portfolio. If I totally make some massive mistakes, which I will, it's bound to happen. Now, I'm not a professional. I'm not giving financial advice to you guys. And obviously, anyone can make mistakes. So even Warren Buffett makes massive mistakes on occasion, although certainly a fewer frequency than I would. So the managed bit is there for the protection, so that if I do wrong, make these mistakes, I've got, for most of these cases, the index funds ticking away in the background, just accumulating over time. And also I've got Linsdale Train Fund and Fund Splits Equity, which are funds whereby they have low number of positions, low turnover, and try and keep the fees low. So it's got like different ethos to the normal funds. And Fund Splits Equity there, although £238, that's going to go up by £100 a month on an indefinite basis. So we've had a look at the dividends, the cyclicals, the managed, and the quality. I'm now into the no categories, where I've got holdings that don't fit any of those categories. So if I didn't own them now, I wouldn't buy them because they don't fit those four categories that I want my portfolio to be within. But, Alibaba has the first one. That's a big holding. I do think I will make money on this holding over a long period of time. It's a good company. I don't think it hits all the metrics for the quality company, which is why I haven't put it in that category. So I think I will carry on holding that one, and I'm expecting to make a return, positive return. And then probably worth shouting out my worst large investment to date, which is Boohoo, down 81% as of end of September. Pretty shocking. I don't think they'll fail. I do think they're undervalued, and I do think when the economy rebounds in a few years, hopefully, I do think they are worthy of a higher market price than they are currently at. I do think they're worth more than market currently values the company. However, I have to eat my cake here, and this looks like a pretty bad buy at the moment. Alright, if you guys holding Boohoo, I know a lot of UK investors have invested in Boohoo. Love to hear in the comments below what your plans are with Boohoo. Let's try and share some intel on that. 3 bad buys that I actively want to sell, but it's very, well, Voyager's dead. So that Huyagan down 60-odd%, pretty poor. It's one of those where do I sell them and lock that in, or do I think, well, actually, I know they're probably worth more than their current market pricing. Do I hold on for that level to be realised, which might still be a loss probably for me. It's a tricky one. What would you guys do actually? Would you sell out of those now? If I know I don't want them, I want to get rid of them. Would you sell immediately and just cut the cords, or would you wait for it to get to that, what I think is a fair price, and then sell it, which would still be a loss, but nowhere near as big as a loss? There we go. That's me in September. That's the transparency. I want to keep that going. Hope to give you some ideas of good and also bad things to avoid. If you want to join us and chat stocks, chat portfolios in our investing community, I'll put a link in the pinned comment below. It'd be great to have some of you join us in that community. We've got a Discord server as well. Otherwise, to see why I'm changing my portfolio approach, as we've described here, click on the link on screen now, and I detail my changes to the approach in constructing and managing my portfolio.